Hey, welcome back to another episode of our City by City Market Pressure Review series. And this time we look at Coffs Harbour. Coffs Harbour is one of the coastal hotspot cities along the New South Wales coastline, together with Newcastle, Wollongong, Port Macquarie, Kiama, and so on. Just like the other cities, the property market here boomed during the pandemic. And then since 2022, it's been quite quiet. Newcastle has been recovering in recent years, so is Coffs Harbour following Newcastle and on its way to recover? Let's find out today with 10 charts. But before getting to the charts, if you are here, chances are you're serious about property investment. But research itself is not enough. If you're ready to make smart and data-backed moves, why not take the next step? InvestorKit offers a free 15-minute discovery call. No pressure at all, it's just a short call to understand your goals and see if we are the right fit to help you buy with confidence and build a high-performance portfolio. If that sounds good, head to investorkit.com.au or check the show notes below. So, let's get started. Chart 1 is an overview of Coffs Harbour's market performance. Rental pressure is really high. Incoming supply is low, so it scores 5 out of 5. Rental yield just moderate, 3 out of 5. If we look at price pressure and cycle position, they're still not really favorable. And affordability is the weakest point now. Just 1 out of 5. So overall, Coffs Harbour's market pressure is still relatively low, but we need more details. In Chart 2 and Chart 3, we look at the demographic and economic trends. So first, population. Population growth hasn't been really strong over the past decade, always lower than Australia's average. For your context, Australia's average population growth rate over the past decade was around 1.5% per year. And as we can see here, Coffs Harbour's population growth was always lower than 1.5%. Overseas migration has been the major contributor to population growth. After COVID, overseas migration remains high compared to pre-COVID, but internal migration is now low. It could be because of the reduced affordability of housing, because theoretically there are plenty of job opportunities attracting both overseas migration and internal migration. And that leads us to Chart 3, the job market trends. The number of job opportunities stays elevated at around 1.6 times of the pre-COVID average level. And if we look at unemployment rate, it did increase from a low 3% to a current 4.7%, but it's still relatively low if we compare it with the 5% full employment benchmark or its own last 10-year average. So overall, Coffs Harbour's local economy is strengthening, and that in coming years will support more population growth and higher housing demand. Now, sales market trend. Sales market pressure has been increasing gradually. We can see that in the consistent decline in the sale data market. In terms of price growth, median price has been trending upward slowly over the past year. It's interesting to see the sudden uptick in the dotted line, which is the 3-month rolling median price line. That could signal the beginning of a series of healthy growth. But at the same time, it could also be a temporary surge like the one we saw at the end of 2023. So we'll need more time to monitor this to be able to tell the actual trend. One of the reasons why we were not sure if the uptick was the beginning of strong growth lies in the inventory level. Coffs Harbour's inventory level is still high, above 5 months of stock. Yes, in the last 2 years, it has largely declined from close to 7 to the current lower than 6. But 5.5 months of stock, it is still far above the 3 to 4 months balance level. With this high level of inventory, it is not easy to achieve a really strong growth. But a good sign is the consistent decline in inventory over the past few months. If this trend continues, growth is likely to become better and better. Now, new supply level. Coffs Harbour's new supply level has always been relatively low, considering its low population growth. The new house building approval rate here has always been lower than 2%, where 2 to 3% is usually considered the balanced benchmark. So in terms of oversupply, I don't think that's a concern for Coffs Harbour. Chart 7, long-term growth. This chart explains why the market cycle position is not considered favorable. Due to the price surge during COVID, Coffs Harbour's last 5-year growth and last 10-year growth were both much higher than the long-term average of 5 to 7% per year. That in general means that it needs more time to correct before being able to surge again. Some regions with a high infrastructure improvement and high population growth might defy this 5 to 7% rule and achieve higher than 7% growth in the long term. But Coffs Harbour is well established and the population growth is just moderate, so it's more likely to converge back to this 5 to 7% per year growth range than exceeding it. Rental market. Coffs Harbour's rental market is tightening, as we can see in the declining vacancy rate. Now it's even lower than 1%. And as a result of the tightening rental supply, rental prices started to grow again in mid-2024 and achieved a very impressive 8.3% annual growth. That growth is much higher than the sales price growth, which was 2.5%. So as a result, we are seeing increasing rental yield, now 4.4%. 4.4 doesn't seem really attractive to many people, especially when interest rates are high. But if we compare it with the higher priced coastal cities, for example, Newcastle, it's already healthier. And on the other hand, rents will very likely outgrow sales price again, increasing this rental yield further. So over time, Coffs Harbour will be attracting more and more investors back. And in chart 10, we'll look at relative affordability in both the sales market and the rental market. Sales market affordability is not looking good, 31% overvalued. In the coming year, as interest rates continue to go down and salaries continue to rise, sales market affordability will further increase. And in comparison, rental market affordability is worsening as rents continue to outpace income growth. In the coming year, we expect the gap between sales affordability and rental affordability to further close, and we'll likely see more demand shift from the rental market to the sales market. And if that happens, it'll give the sales market recovery another boost. So what's going to happen in the coming 6 to 12 months? Sales market pressure is still relatively low with a high inventory and high days on market, but both are declining. Rental market, in the meantime, is quite tight. So based on that, sales prices will likely continue to grow in moderate paces, while rents will continue to grow healthily. As a result, yields will continue to increase, sales affordability will continue to increase, and attract more buyers' demand back to the sales market. So that was Coffs Harbour in 10 charts. I hope you enjoyed it. If you have any questions or anything to discuss, leave your comments below. I'm Joan, the Senior Research Analyst here at InvestorKit. I'll see you next time.